Welcome, future chartered accountants. Are you ready for a high-octane revision explainer? Today, we are conquering every single provision, exception, and sneaky exam trap for share capital and debentures. If you're gunning for that all-India rank, you need absolute, crystal-clear conceptual clarity on Sections 43 to 71 of the Companies Act. We're not just reading provisions today, we're literally hacking the examiner's mindset. We're going to uncover those hidden traps and lock these concepts into your brain for good. So grab your notebooks and let's get right into it.
Okay, here is our mega revision roadmap. We're covering types and rights of shares, issuing shares, capital alteration, share buybacks, debentures, and trustee rules, and capping it off with a final mega revision cheat sheet. Let's do this!
Starting off with block number 1, types and rights of shares. That covers sections 43 to 48.
Now, this is a solid medium probability area for theory questions, and honestly, students mess up the core difference here all the time. But keep it simple. Preference shares, they get VIP treatment. They are literally first in line for dividends and for repayment if the company ever winds up. Equity shares, on the other hand, hold the actual voting power. Think of a massive conglomerate, like Reliance. The equity shareholders are the real risk-taking owners steering the ship, while preference shareholders are just there for a more secure, preferential return. Make sense?
Okay, pay attention, because this is a 3-star, high-probability concept. Equity with differential voting rights, or DVRs. For a practical business example, think of Tata Motors. They issue DVRs to raise capital without giving up promoter control. But listen, here is the absolute golden rule the examiner loves to test. DVR voting power can never, ever exceed 74% of the total voting power at any time. Never. Plus, to even issue them, the company needs a squeaky clean track record. That means no defaults in filing financial statements for the last 3 years, and 0 defaults in paying dividends, loans, or employee dues for the last 5 years.
Moving right along to Section 2, issuing shares and sweat equity. We're looking at sections 52 to 55, plus 62 and 63.
Let me ask you a question. Can a company issue shares at a discount? This is a classic exam trap. Section 53 is crystal clear. Any share issued at a discount is completely void, period. And what if a company breaks this rule? Well, they have to refund all the money to the applicants, plus a hefty 12% interest per annum right from the date of issue. But, as you guys know with corporate law, there's always an exception.
And that highly tested exception is sweat equity under Section 54. This is basically equity issued at a discount or for non-cash consideration, specifically to directors or employees. It's perfectly designed for, say, a tech startup wanting to reward its founders for their intellectual property or know-how. Now, write down this memory trick. Call it the 3 and 12 rule. Sweat equity shares are locked in, meaning they are non-transferable for exactly 3 years. And the special resolution you pass to issue them, it's only valid for 12 months. Oh, and remember, a registered valuer has to price these shares and the IPR.
So what happens when a company needs to raise more money later on? That brings us to Section 62, further issue of capital. Practically speaking, a rights issue lets the existing owners keep their control by offering the new shares to them first. They get a tight 15 to 30-day window to either accept or reject. Then you have ESOPs, or employee stock options. These require a minimum 1-year vesting period to actually keep the employees loyal. And importantly, they expire the moment an employee resigns. Lastly, there's preferential allotment. This lets you target specific investors, but you're going to need a special resolution and a registered valuer to lock in the price.
All right, Section 52, the securities premium account. You absolutely must memorize what you can use this for. You can use it to issue fully paid bonus shares, write off preliminary expenses, or even for the buyback of shares. But look at the red flag here. Can you use it to pay dividends? Absolutely not. Never. Unauthorized use of this premium account is legally treated as a deemed capital reduction, and trust me, you do not want to invite those penalties.
Up next is Section 3, Capital Alteration and Capital Reduction. That's Sections 61 and 66. Listen, students constantly mix up alteration and reduction, but they are vastly different legal processes. Alteration under Section 61 is just a simple internal restructuring. It only requires authority in the Articles of Association and an ordinary resolution. You can do 5 things: increase authorized capital, consolidate shares, convert shares to stock, subdivide them, or cancel unissued shares. Here is the massive exam takeaway.
Canceling unissued shares under Section 61 does not trigger the strict capital reduction rules. You literally just file Form SH7 with the ROC within 30 days, and you are good to go. Capital reduction under Section 66, however, is a totally different beast. This is a 3-star high-probability practical question area. This happens when a company cancels paid-up share capital that is lost or unrepresented by available assets. Because this directly impacts company wealth, you have to follow 4 rigorous steps to protect the creditors. Step 1, pass a special resolution. Step 2, apply to the tribunal. Step 3, the tribunal notifies the creditors, the ROC, and SEBI, giving them 3 months to raise objections. Only after all that is settled will the tribunal pass the final order, which you then file with the ROC within 30 days.
Buckle up for Section 4, Share Buybacks and Transfer Rules, covering Sections 68 through 70 and 56 through 59.
Buybacks are an absolute favorite for RTP and MTP practical questions, and the magic number you need to remember here is 25. An overall buyback cannot exceed 25% of the total paid-up capital plus free reserves. Furthermore, if you're buying back equity shares specifically, it cannot exceed 25% of the paid-up equity capital in a financial year. So just lock that number 25 in your mind right now.
The absolute core of the buyback rules is keeping the company solvent. Post-buyback, your debt-to-equity ratio cannot exceed 2-to-1. You can fund the buyback from free reserves, securities premium, or a fresh issue of a different kind of shares. Now, underline Section 69 in your notes. If you use free reserves or securities premium, you are legally required to transfer a sum equal to the nominal value of the shares you bought back directly into the Capital Redemption Reserve, or CRR. Why? To maintain a capital buffer so the creditors don't lose out. Also, once the buyback is done, there can be no fresh issue of the same kind of shares for 6 months, except for bonus shares.
Let's do a quick 30-second recap comparing transfer versus transmission under Section 56, because examiners love testing this. Transfer is a voluntary act. You sell your shares, money changes hands, so there's consideration, and you absolutely must use Form SH4. Transmission, on the other hand, happens by operation of law. Think death or insolvency. Because of that, there is zero consideration involved, and no SH4 is required at all. A simple legal intimation does the trick.
You must memorize this timeline for delivering security certificates under Section 56. For a transfer or transmission, the company has 1 month to deliver. For subscribers to the MOA, it's 2 months from incorporation. For allotment of shares, it's also 2 months. But here is the massive exam trap. The law actually gives a super generous laid-back 6-month window specifically for the allotment of debentures. Do not let the examiner trick you into saying 2 months for everything. It's 6 months for debentures. That brings us perfectly to Section 5, Debentures and Trustee Rules under Section 71.
Never forget the golden rule of debentures. They can never carry voting rights. They are corporate debt. They are creditors, not owners. The maximum redemption period is 10 years, though infrastructure companies get a bump up to 30 years. Now, if a company makes a public offer or issues debentures to more than 500 members, they absolutely must appoint a debenture trustee. And here's where it gets interesting. If the company defaults, that debenture trustee, if backed by a written requisition from holders of just 1/10 of the outstanding value, can call a meeting and literally drag the company to the tribunal.
Okay, this right here is a 3-star guaranteed exam trap. The Debenture Redemption Reserve versus the Debenture Redemption Investment, DRR versus DRI. Listed companies, as well as unlisted NBFCs and housing finance companies, have a nil DRR requirement. Practically speaking, only other unlisted companies are forced to create a 10% DRR. But, and this is the big but, almost everyone has to invest 15% of the amount of debentures maturing that year into safe securities as DRI. Do not confuse the 10% DRR with the 15% DRI when you're solving those practical questions.
And finally, Section 6, our mega revision cheat sheet. Consider this your one night before the exam survival guide.
I want you to take a mental screenshot of these top exam traps. Look, students lose marks all the time because they forget that the Capital Redemption Reserve, the CRR, has exactly one legal use, issuing fully paid bonus shares. That's it. Remember that issuing shares at a discount is entirely void, unless it's sweat equity. Remember that DVR voting power is strictly capped at 74%. And make sure you know the crucial difference between a blank transfer and a forged transfer.
Speaking of which, here is the ultimate legal absolute you need to quote if you get a case study on forged transfers. A forged transfer is a complete nullity from the very beginning. It never, ever passes title, not even to a bona fide purchaser who bought the shares in good faith. The company is legally bound to completely restore the name of the real original owner to the register of members and pay them any dividends they missed.
We have officially conquered every single critical provision, exception, and trap from sections 43 to 71. You now have the conceptual clarity of a top-tier AIR student. So review this explainer one last time before you walk into that exam hall. Visualize these concepts, trust the hard work you've put in, and go ace that paper. When you see that tricky 6-month debenture timeline on your exam tomorrow, you're going to know exactly what to do. Good luck!